All right, everyone. So welcome to Create Cashflow's first podcast, and we've been lucky enough to be joined by Alex from Aqwire Financial. Today, what we're going to be doing is we're going to be touching on two topics. We're going to break it up into two podcasts because we'll probably go for a while. We're going to be going broking and SMSF, some information from the inside. Sitting beside me, we've got Anthony, co-founder of Create Cashflow.
Thank you. Very tall today.
You're very tall today. I'm 6'7", he's 5 foot nothing, and they've stitched me up with the little kid seat and put him up there. So
I'm a short 6 foot. Actually.
You're a short. Oh, mate. Well, Alex, you got a little bit of a rap sheet, and I can't remember it all, so I'm just going to read it. So you've got over a decade of experience in offering professional advice to high network professionals and families and individuals. After working for some of Australia's premier financial services companies, Alex established Aqwire Financial, a multidisciplinary financial planning and mortgage broking business for time-poor professionals, families, and individuals, much like our clients, which is why we love referring to you. With qualifications including a Bachelor of Commerce with majors in economics and finance, and also you have an advanced diploma in financial planning.
He's a genius.
That's a mouthful.
There's a bit there, yes.
There's a bit there.
Yeah.
Mate, have you got
and I wrote that. That wasn't ChatGPT.
You wrote that?
Yeah.
Mate, have you got anything you'd like to say before we kick off?
Thank you for having me. It's a pleasure to be here. Yeah, it's really looking forward to it.
Yeah, mate. Looking forward to jumping into it. Do you have a disclaimer you might want to chuck in there for any of those ones who want to hold you to your
Yeah, just the the general disclaimer that obviously my discussion here is general in nature. So anything of a personal nature or any individual circumstances, please consult a licensed professional, i.e. myself.
Yep. At Aqwire Financial. All right, mate. Why would people want to choose you over just going straight to the bank?
Yeah, no, good question. So I guess from a mortgage broking perspective, obviously mortgage broking allows the consumer to have more options than going direct to one bank. If you're going direct to Westpac, you're obviously only dealing with Westpac loans. The benefit, I would argue, about consulting a mortgage broker would be for that mortgage broker to consider all your options, with up to 38, I believe it's 38 different lenders that I can choose from on my panel. And amongst that, obviously, making sure that particular lender is appropriate and is aligned with your individual circumstances. Basically, it's a matter of choice.
Yeah.
That would be the key point. A mortgage broker has the option to choose across a number of different lenders compared to just the one. To expand on that, I would also argue the point that obviously different lenders have different policy guidelines, right? So for self-employed people, some lenders will offer better policy, better borrowing capacity, better serviceability constraints on a self-employed person than some other lenders. And that's particularly relevant too for some clients that are onto their third and fourth investment property, may find themselves constrained with a particular lender. So I guess one of the other benefits of a mortgage broker is we can look at lenders sort of outside the branch space, if that makes sense.
Yeah, I think when you mentioned there, serviceability, borrowing capacity. Once we get to that third or fourth property, that's generally where we find the right barriers. But you also touched on, is that bank appropriate for you?
Yeah, absolutely.
Now, we generally like to diversify our clients going through different banks depending on what stage they're with. Maybe they might need. We know that to get into the next property, they're going to need a bit of borrowing capacity, or they might need a really favourable property valuation, and that's something that obviously using a broker, you get the benefits of. So if we speak to you and be like, listen, we workshop some ideas, and we know that we need to pull out X amount of equity on the next one, well, we know we're not going to use one bank.
Yeah.
And we might use, there are certain banks, I don't know if we're able to say them, but some banks do, really give high valuations. I mean,
Yeah, particularly, sometimes, it all depends, but To expand on your point there, like some lenders prefer certain securities over other lenders, right?
Yeah.
And we know that for a fact with certain security types. So, the idea of one bank fits all just isn't true, and I think that's probably one of the key points of difference for using a mortgage broker, amongst the fact that I believe up to 65% of Australians use a mortgage broker now too. So it's a pretty popular space.
Yeah.
It should really be 100%, if you ask
Yeah.
me, because it's free, you do all the work, and you look at 38 options instead of one, or
Yeah.
38 or 40, whatever it is. So I think it's crazy not to use one.
Yes.
Yeah,
of course.
Yeah.
completely. Yeah. It's a growing space, obviously, and just touching on lending in general as well. Like the technology is getting a lot better.
Yeah.
And we're experiencing not only favourable results with approvals and settlements, but just the speed
Yeah.
of getting things done. And that's not just the mortgage broker, but also obviously the lenders as well, improving their efficiency and getting things done a lot quicker. But yeah, from a high level, choice is the big one, right?
Yeah.
It's the
Yeah.
fact. The fact is, I've got 38 different lenders to choose from. Whilst if you walk into a bank branch, obviously that bank branch is only...
You got the one bank, the one product, I mean, like variable, fixed, whatever it may be, but that's all you're really going to get.
You're spot on.
And they're not going to tell you why another bank is better for you than them.
Correct.
Yeah.
Yeah.
And generally, people are with the big four, and a lot of the time, the best ones aren't the big four.
Yeah,
bank
yeah.
Anyway, like the non-bank lenders.
Absolutely. Yeah. And
Especially for those third and fourth properties, the ABN, sole traders,
yep.
they're much more flexible. You know, your First Max and Latrobes and all that fun stuff. They're really good
Yeah.
for
No,
yeah.
Yeah, for
Yeah.
seasoned property investors, absolutely. Yeah, they'll help those clients obtain that next purchase because that's their space, right? The non-bank lenders or certain other lenders, then the big four, their specialisation is helping those seasoned property investors purchase their next third or fourth or fifth or whatever it is. That's their space.
Yeah.
Mm.
Well, most of the time, people are a little bit afraid of going to non-bank lenders. I find every time I speak to the client, maybe they have one or they've got two properties, maybe an owner or one investment. They've always gone through Westpac, CommBank, NAB, whatever it may be. And as soon as we mention like a second or a third tier lender, they're a bit pulled back. They're a little bit afraid of it because they think second or third tier lender means massively high interest rates, which isn't necessarily the case. If more circumstances are not, for a first tier lender like your CommBank is going to have higher interest rates anyway.
Yeah, depending on the discounts offered, absolutely.
Yeah.
And I don't want to sit here and kick the big four entirely because they...
Why not?
Yeah. But yeah, you're quite right. I guess for those seasoned investors and clients that are having serviceability constraints with the big four can look outside the big four and potentially obtain a better deal. So yeah, it's an exciting space.
Yeah, awesome. Two kind of valuations. We've got desktop and we've got a physical val.
Yep.
It's not always best to get a physical val. Sometimes it's best to just get the desktop.
Yeah.
What's your experience with that? And I guess touch on what the differences are.
Yeah, so there's two types of, as you quite rightly point out. So there's desktop valuations or curbside valuations, which are basically a valuer completing the valuation report digitally.
Yeah.
And the curbside is...
Your Google Maps Street View.
Correct. And the curbside is actually, the valuer will physically go out to the curb and take a photo of the dwelling or the security and then complete his or her report. And prepare the report for the lender. And then obviously you've got a full valuation, which is the valuer physically arranging a time with the agent, the tenant, or the particular owner if they're refinancing, and physically going inside the dwelling and valuing the asset that way.
Yeah.
Obviously there's trade-offs with both. One thing to note is a full valuation will always... in terms of the assessment scale, a full valuation will always supersede a desktop valuation, if that makes sense. So if you get a full valuation and you're not happy with it, generally you can't go above that.
Yeah.
A desktop won't supersede a full valuation.
No.
So speed's also another thing. Like if you need a quick settlement, a quick approval, you don't want to be getting a full valuation.
No, you can generally get a desktop val that day.
Correct,
If you chat to them in the morning, it's that day. If it's later in the afternoon, you can still possibly get it that day, but in the morning time.
Yeah.
Really, the only time personally myself or our clients have got physical vals is when they've done renovations to the properties. Yeah. They've added a bathroom, whatever it may be, so it doesn't fit the standard. Yeah. I do find that when people go out and physically attend it, because they are third party, it's not the actual bank that goes and assesses the property. It's a third person, or a third party, that goes out and does it for them and then reports that back to the bank.
Yep.
And most of the time I find they're very, they undercut the price. Mm-hmm. And because a lot of the time, sales are 3-4 months in arrears. Mm. By the time we have a sale on a property and it hits realestate.com, because let's be honest, that's what they're using is the val. Yep. They're 3 or 4 months in arrears, and we saw it through COVID where prices were jumping and jumping and jumping, where realestate.com and online weren't keeping up with it, where the valuers that were doing the physical val were giving 3-4 months ago prices, and in times where we see rapid growth in a short period, that can be the difference between $40,000-$50,000 in val. Yeah,
absolutely, especially in the southeast Queensland market, as we've experienced over the last couple of years since COVID. But from a full valuation perspective, it generally takes a little bit longer and requires a physical inspection. One thing to note is when you're borrowing above 80%, and generally that sounds counterintuitive. Why would you borrow more than 80% if you're going to pay lenders in mortgage insurance? Well, for certain professionals, as we know,
opportunity cost comes into it as well.
Yeah, but you're quite right. But some professionals, some individuals qualify for what we call lenders mortgage insurance waivers, where if they're they're working in a certain occupation, such as a lawyer or a doctor, a dentist, even a nurse potentially, can qualify to borrow up to 90% without having to pay any lender's mortgage insurance.
Yeah.
Obviously, are we familiar with lender's mortgage insurance? Do you want me to talk?
Explain it briefly.
Yeah. So lender's mortgage insurance is basically if we're borrowing more than 80% of the value of the property, the bank will make that borrower pay a premium, an insurance premium, for what the bank deems to be additional risk. Yeah. So it's basically you're paying the premium to insure the bank of your default.
And most LMI companies are not a part of that particular bank. Some of them do. Some, I think NAB has their own LMI company.
Yep.
But your second and third tier lenders, it will actually be a third party. They're taking an insurance premium out on you.
You're quite right, yes.
For that. So, and most of the time it is very beneficial, as we said, opportunity cost. If we have to pay $6, $7 grand, $8 grand, whatever it may be, obviously depends on your purchase price and what you're redrawing out on, is if you pay an extra 20 grand, but we can secure a property for you, that 20 grand on your interest rate over 20 years is going to be dwarfed by the growth of that period over that same property over that same period. So it all comes down to opportunity cost.
Yeah.
And having a plan.
Yeah, absolutely. And you're quite right. It's an opportunity cost in that regard. But for certain occupation groups, and they may well be very surprised, they could borrow up to 90% either to purchase a property to live in themselves or invest an investment property without having to pay lender's mortgage insurance. Mm-hmm. It's quite a huge consideration by certain lenders that are offering that sort of thing. So, which goes back to the valuation. If you're borrowing more than 80%, even if you have a lender's mortgage insurance waiver, prepare for a full valuation. That's just a stock standard policy. Unless the property market in that particular area has performed very, very strong, sometimes you may get away with a desktop, but generally anything $1 over 80%, and you're pretty much in that full valuation realm.
Just to clarify, when Sean said you pay an extra $6,000-7,000, you don't pay that cash, right? Just
No,
goes
not
into
at
the
all.
loan?
No, it gets capitalised on top of the loan.
Cool.
Yeah, you're quite right.
Because a lot of people say they want to pay a 20% deposit to avoid LMI,
Yeah.
but then they can only purchase, I don't know, 300-400 grand versus 500 or 600.
Exactly right.
So
Well, you got to
like-
double your deposit on a $600,000 property, 20% deposit, you get 120 grand.
Yeah.
Yeah.
How long does it take you to save that? It's the opportunity cost. How long does it take you to save an extra $60,000 to reach the 20%? Compared to if you got $60,000 in savings, you can pay 10%.
Yeah.
Pay your LMI.
Yep.
Yes, obviously you got fees, legal fees and stuff to go on top of that stamp duty. But let's just say you got $60,000 for a deposit.
Yeah.
You know, it might take you an extra 2 or 3 years to save up that extra $60,000, if not more.
Yep.
You know, depending on your salary.
Yeah.
And that property that you were looking to purchase for $600,000 is now $900,000.
Literally.
Because it'll take you that. Then what are you going to save up 20% for that?
Your $300,000.
All opportunity cost.
Yeah, your 300,000 in the hole. Yeah.
I would happily pay LMI every time,
Yeah.
really.
I
just
paid
to-
it. Yeah.
Same.
When I bought my first property, I paid it, and no one wants to pay it, right? It's not a nice thing to do, but I paid it, and I'm very glad in hindsight that I paid it.
Yeah.
Because it allowed me to get in.
Yeah.
And yeah, for some people, I know we're talking about investing in property, but for some people, it's the difference between them having a roof over their head, right?
Yeah.
Or not. So sometimes the premium can be favourable, but at a certain amount, I would argue.
Yeah, cool. Did you want to explain as well for self-employed people versus PAYG? So there's obviously when you're self-employed becomes more complex.
Yep.
Did you want to explain?
Yeah, I think this goes back to my journey in financial services and the fact that over the last 10 years of working in the financial services space as an advisor and a mortgage broker, there's been so much change. And one of the really significant changes I've seen is around self-employed policy of late. So historically, if you were self-employed and you ran either a company, so you were self-employed in a company structure, a trust structure, a sole trader structure, you would need to show a bank 2 financial years, the previous 2 financial years of company tax returns, financial statements, so profit and loss and balance sheet, as well as individual tax returns as well. So 2 financial years. So it's a significant hurdle. Now, not all lenders, but some lenders are now assessing self-employed people with 1 years of financials, company tax returns and individual tax returns.
Nice.
And they're not only lending on what you're paying yourself as a director potentially, but they'll also lend on the profit of the company, add-backs of which we know, like depreciation, additional super contributions that are being paid for you from your company, as well as profit distributions to particular family members as well through a trust potentially. So the policy has really, it's changed significantly for the better, I would have thought. And I think that also demonstrates the appetite for a lot of lenders at the moment. And I know this for a fact. Their volumes are down, so they're hungry for business. And I think that's one of the key reasons there around self-employed policy. They're keen to get good borrowers, good customers on their books.
The 2 years self-employed previously, because I guess now you can get around that, that was tough for a lot of people because all the businesses want to write off as much as possible.
Yeah.
So they'll claim deductions and then that might run at a loss for a year or whatever.
And that'll run it. They'll be like, damn it, now I need to have 2 years worth of clean.
Yeah.
But now, as we looked at, with other
certain
clients that are working with you, it's much more flexible with one opportunity using a broker, as we spoke about before, looking at all different kind of banks. But this particular client was a Melbourne client. They had to shut up shop just because of their industry. They had a very quiet 2 years ago. This year, or two financial years ago.
Yeah.
Last financial year, they had a very successful year, bought a couple of big assets, one-off payments, and, the certain bank that we're using is assessing the last financial year only and adding the depreciation back onto it.
Yep.
Which,
Yeah.
as you mentioned a couple of years ago, we would have said, sorry mate, we can't work.
Literally,
with you."
don't even bother
Yeah.
walking in the door.
Get
literally,
out.
Get out. What COVID? What was COVID? Get out. COVID affected, and which is literally the 2022 financial year.
Yeah.
Is from 1 July 21, which Sydney and Melbourne, half the country was literally locked down. So it's really, really good that those particular lenders are offering these sorts of policy guidelines, and it's forever changing, right? But I think it's a real favourable thing.
Love it. Next one is for people that are preparing to purchase and wanting to set up their borrowing capacity.
Yep.
Obviously, you want to increase your income, you want to lower expenses. What's the best way to sort of set yourself up for maximum borrowing?
Yeah, so serviceability killers. Sounds a bit morbid, doesn't it? But killers. Serviceability killers. Okay, serviceability reduction. So it goes without saying in many respects, but it's important we discuss it. So car loans are a significant reduction in one's serviceability or one's ability to borrow money to purchase a property. Car loans, leases, credit cards, HEX. HEX is a necessary evil for a lot of professionals, and I completely understand that.
People underestimate how much. They'll say they're all clean, they've got no debts, no nothing. Everyone forgets about the HEX debt. Yeah. We've had so many clients come in, obviously referred to you, and they'll be like, yep, we're good, but they've got $120,000 in HEX, and the banks are just like, oh, that changes your borrowing power from like $700,000, $800,000 down to like $300,000.
Absolutely.
Huge.
So for someone, it's great point. So for someone on $150,000 a year, and this is an example, $150,000 a year, they are paying $13,500 a year, roughly, in HEX, right? So that's deducted from their income.
Yeah.
Borrowing capacity is reducing significantly from that. And then if you put on a car loan or a lease or a credit card on top of that, the borrowing capacity is literally halving.
Yeah, at these high interest rates, when you're getting assessed, let's just say you're going for a 6.5%, 7% interest rate, some banks are adding 2 to 3% buffers, so you're getting assessed at 9 or even certain circumstances 10% if you're going interest only or a low doc loan, whatever it may be.
Yep.
You're getting assessed at 10%.
Yeah.
And I don't have the figures on me, but I remember getting someone to look at it, and I think it was a $100,000 car loan takes off your servicing by nearly $250,000, $300,000 for a $100,000 car loan.
Yep.
Massive difference.
Yeah, I don't doubt it. Yeah, it's a significant reduction in your ability to purchase. To answer your question, Anthony, so store credit like Zip Pay, Afterpay, that will hurt your serviceability. Leases, car loans, credit cards. Most people have a credit card, I get that, but if we're approaching this from an application point of view, and you're looking to potentially purchase in the next few months, now would be the time to consider either paying down your credit card debt or potentially look at, depending on your liquidity and your access to cash, potentially closing that credit card if you're looking to maximise your borrowing capacity to purchase a property in that regard.
If someone doesn't have the opportunity or the available cash to pay down car loans, to pay down credit cards, Afterpay or whatnot, but they have an existing property with equity.
Yep.
At what point would you suggest for serviceability to pull out equity from your property to pay off those loans? Is there a point where you would suggest that for borrowing power?
I can't give you a general answer because it would depend on one's individual circumstances. But let's just expand on the facts of that. So say that credit card or that car loan had just been taken out and has a 5-year term. And this is a fun little exercise if you ever jump on an amortization calculator.
I'm just going to jump in here. Financial advisors and brokers have really weird versions of what fun is, so strap yourself in, guys.
Yeah. If you need to sleep, listen to this. So an amortization calculator will show you over a 5-year term on a car loan, you will pay all the interest on that loan, or at least the majority of the interest, in the first 2.5 years of the term. So that's how the lender gets their money, right? They load the interest at the start, and then at the back end of the term, that's when the principal will actually start going down quite significantly. So to come back to your question, when is the best time to pull out equity in a home and essentially pay out those debts? If you were going to do it, you would do it earlier in the term of the particular liability that you're looking to refinance. But that also has its trade-offs as well, because all of a sudden you're cashing out equity to pay out a loan that has a 5-year term, and you're now consolidating that debt into a 30-year term.
Yeah. So
you may be a little bit worse off over the long run. However, if that helps that particular individual then go out and buy another property, potentially that could be worthwhile as well. Hence,
it all comes down to opportunity cost.
Yeah.
Because when it comes down to it, it's if you have $50,000, $60,000, $70,000 worth of debt you need to pay off, if that $50,000, $60,000, $70,000 is making you not able to get a home loan, if you were to pull out that equity, pay it off, and then now all of a sudden it frees you up to purchase something that's worth $600,000, $700,000, $500,000, even if it's $400,000 purchase price. Mm-hmm. Over that time of the loan, if we go your stock standard 7% annual growth on properties, if we can purchase something for $400,000 and in 10 years' time it's worth $800,000, give or take doubling every 10 years, we've made ourselves $400,000. The opportunity cost would be the extra interest on that $60,000, so to speak, over the life of the loan, which, it is discussed, but it dwarfs the extra interest paid.
Yeah.
If it opens you up to be able to borrow.
Yeah.
You wouldn't do it if you can't.
It's like the LMI conversation, exactly.
Yeah.
So it's like we're capitalising an insurance premium on our loan that we're going to pay back over 30 years. We're capitalising debt that's being used to purchase a car, potentially, or personal expenses over 30 years. It's that sort of exact same concept in a way.
Yeah.
To then ultimately help us purchase additional growth assets like property.
One simple one, I think, is people always say, or like when people are young and growing up, they'll say, I'm going to get a car first.
Yes.
And then I'll buy a house or a property. But then that car loan just wipes their serviceability. So if you can just swap it, do a property first. Yep. Once you're approved, then see what you can do.
Do you guys remember your first car?
I do.
What was Spinner?
Oh, it's bad. Holden Commodore.
Oh, yeah.
Oh, that was better.
I'll one up you.
That was better than what I could go.
Good?
Yeah.
That's not good.
An AU Falcon.
I don't even know.
Oh, I remember that.
The Falcon, you'd remember that.
I remember the silver
Ford Falcon.
Falcon.
It's like the ones
The
with
sedan.
they like had goggle headlights.
Yeah.
From the 1990s.
Guys, I'll beat you all. I had a 1987 5 Series BMW. I bought for
BMW is not bad.
Yeah, you know, like you see all those Middle Eastern war movies, how they've got that real old shell-shocked, BMW. It was like that. It even had the hole in the exhaust. That was, I think I bought it I overpaid. It should have been like $1,500. It was like $3.5 grand I bought it for. At that time, I was in the military, and I was driving onto base, and every time I drove in, they would check under the car for just to make sure it's all safe and good to go. That's how good it was. But I'm glad I did it, because if I did, like, people that could be listening to this, they could be military, they could be FIFO workers, whatever it may be, got a nice paying first job. A lot of the time people think, oh yes, I'll get a new car. They've just got out of university. The old joke of back in the day, now they don't make Maloos. It's, the old miner would go get a Maloo on a jet ski, blow all 2 weeks worth of income in the 2 weeks they're away.
Yeah.
But And unfortunately, a lot of the time people in the mines earning big dollars, but they come back and they have too much fun. And they're left with nothing but a bunch of depreciating toys.
And then go back to the mines again.
Yeah. That's a serviceability killer like no other. And I think a lot of people think like it's to save tax as well. Like they think, especially with novated leases, the concept of novated leases is if you're working with certain employers, you can
education
education,
whatnot.
teachers, definitely teachers, nurses can actually lease a car and effectively pay that lease out of their gross salary.
Pre-tax dollars.
Which sounds great in theory, but as we've been speaking about, it will reduce the serviceability for that particular person to then go and buy an asset that will go up in value. So I try to say to my clients sometimes, you got to pay to play, right? You got to pay your tax sometimes.
I stole that one off you, by the way.
Yeah. That's all right. You're forgiven. You got to pay to play. So, although we don't want to be paying unnecessary taxes, paying a bit of tax sometimes isn't the worst thing either.
Yeah.
Especially if it's for coming from assets that are going up in value.
Yeah. Nice. And that's the same with super contributions too. If people are doing extra contributions to their super.
Yeah, that will reduce their tax as well. So
and borrowing.
And improve their borrowing, potentially if they're looking to purchase in a self-managed super fund.
Okay.
Yep.
Okay.
Yep.
Cool.
I think probably the biggest thing I've taken from this, and I hope the people who listen to this take from it, it's all about opportunity cost. Is if you want to get the car, but understand your opportunity cost. How does that hurt your borrowing? It's going to be big. Or you could practice a bit of delayed gratification, which most of the successful people have, lived out of the garages, do whatever they want to do. But make like myself is, I didn't buy a nicer car until I was able to pay for it and have the profit from my investments pay for the loan of that particular asset. So I got my asset, I built it up, and then so essentially, give or take, depending on how you want to work it, girl math, as we see those funny videos, it's the profit from my investments are paying for my toys. Yeah. So I'm essentially I'm not paying for it.
Yeah. And I don't think we're saying here that don't go out and buy a car. We all need a car. We need a car, we need to eat.
But do you need the $90,000 car? Or could you just suck it up for a little bit and get your Hyundai i30? I drove a Kia Cerato I'm 6'7", and I don't. Because the Simpsons guy.
Yeah, I was gonna say that.
Are you laughing at me in my automobile? It's the biggest I could afford.
You beat me to it.
Sometimes you just got to do what you got to do, and if you think long term, especially if you're a 19, 20-year-old and you've decided to go to the mines, or you've started your own trades business, whatever it may be, just pay your dues, pay your taxes, get the work car that you need, but you don't have to get the top of the range Hilux, maybe just get a Triton or whatever if you need secondhand, and just buy your properties, do your investments, and
build out.
And build it up.
Build up your growth asset base.
There's a time and a place for everything, but your buying window might only be 5 to 7 years.
Yeah.
And then by that time, it's accumulation phase, and it's just, the time is your profit.
Yeah.
Can you hold off for that 5 years to stop the toys, to be able to purchase your properties, to at 25, set yourself up?
Yeah. Yeah, it's, I say this to my younger clients too, it's, especially clients that are below the age of 30 or 35, so to speak, is your focus has to be to build up your asset base, being your growth asset base, not depreciating asset base. But you get, quite rightly as you point out, Sean, you get that asset base up. And even if it is secured by debt, I get that, right? We've got to borrow to buy these assets. Yeah. But for example, you've got $1 million worth of assets, be it property, superannuation, potentially shares as well, or property. And that's $1 million, and that's growing at 10% a year. That's $100,000 a year you're not having to generate yourself, right? Yeah. It's extremely powerful. Now, we all know that in theory. The to actually live it and experience it is a pretty unique thing, and that's the testament to delaying the gratification, as you said.
Nice, love that. What about with people? Hopefully, they do the right things, and they won't have these issues. But if they're younger and they either can't get borrowing, or let's say an investor that's got a few properties, can you talk about using guarantors and joint ventures as well, potentially, for seasoned ones?
Guarantoring is a big thing at the moment for a lot of younger borrowers that can't generate the deposit as such. So it could be anyone. It doesn't actually literally have to be a parent. It could be a brother, sister, sibling. But they can guarantee, the guarantor can guarantee not the entire house, but a portion of that equity to help that potential borrower fund their deposit to purchase a property without potentially having to pay lender's mortgage insurance, or if less lender's mortgage insurance if the deposit is less than 20%.
Is there a difference between a guarantor funding finances and funding a deposit?
A guarantor finances is in serviceability, or
Yeah, so helping with your serviceability. So they'll go guarantor on the loan, not just for the deposit, but actually for the full finance.
Definitely.
Some people might be able to service the loan, but they don't have the deposit.
Yeah, they'll need, you can guarantor equity, you can guarantor like security deposit.
Yeah.
Guarantoring serviceability, I believe it's virtually impossible unless that particular person is going on the loan themselves.
Going on the loan? Yeah.
If they're going on the loan as a borrower, a co-borrower, then they're a borrower.
Yeah.
Then their serviceability will go onto the loan.
Does your guarantor need a job? If someone's going guarantor for you, do they have to have a form of income to be able to guarantee you or guarantee you?
Guarantee their equity?
Yeah.
No, they don't. No, it could be anyone.
Yeah.
Yep.
Interesting.
Yeah.
Okay.
So it could be your retired parents got a fair bit of equity. They just guarantee that. They don't have to do they have to financially prove that if they can guarantee that 20%?
No.
Nothing. So
no,
they just
need to
pull the deposit across.
Yeah, just the deposit. The bank will take a second mortgage over their the equity that they're pledging to the borrower.
Yeah, and at what point does that guarantor get released?
Good question. So once the value in the purchased property, or there's enough equity in the purchased property above greater than
percentage.
20%, greater than 20%, then the two borrowers or the borrower can refinance.
Yep.
They could stay with their lender, or they could go to another lender. Basically, get the property valued, and assuming it's now and now has more equity than what the guarantee was, can effectively have that guarantee removed.
Yep.
And they are then essentially their own borrower, and the guarantee and the equity
is released, and their house is now unencumbered.
The mortgagee, correct. Yeah, spot on.
Cool. I think it's all about just looking good to the banks, making yourself look clean.
Yeah.
And you can be a bit creative with it. I was going to ask if you've got, for example, one partners, one's working, one's not, not married yet. Is there certain strategies you can use, like one doing the loan, one staying off, things like that?
Yeah. We're talking like mat leave, for example. Is that what was you talking about?
Or even before that, if they're just like boyfriend, girl, or hopefully they're working then.
Yeah. It's a bit of a tricky one because basically the bank will want to see the lender, the bank, it doesn't matter, but they'll want to see that whoever's on the loan application is also going to be on the title.
Yeah.
So if both applicants are going on the loan application and there's only one person working,
getting an income,
then the bank is then going to assess their expenditure and their commitments as two people. Yeah. That makes sense.
So that person with the salary will have a dependent, which will be the other person on the loan, effectively.
Correct. So then the argument is, well, can't we just have two on the title and one person on the loan? And that's no. So banks won't let two people on the title. They won't lend money to One borrower.
And have 2 on the title.
Correct.
What about if you have 1 on the title, 1 with the loan?
That's fine.
Does their spouse come into serviceability?
Yeah, if they're on the application,
Yeah, but if they're not on the application, you can just be a single person applying for a loan with 1 on the title.
That's creative.
We like creative.
Yeah,
So,
yeah. Creative
any
cash flow.
other?
Well, we should call ourselves creative cash flow.
Yeah.
Is there any other creative ones, or are you not allowed to give those?
No, well, Alex it's all about reading in between the lines. Is how far to that boundary can you go while staying within what's allowed?
Yeah, that's not allowed. So, not you can't disclose to a bank that you're
single when you're not.
Yeah.
Yeah.
Correct. Yeah.
If you've got a girlfriend or a wife that's not working, even if you're getting on the loan by yourself,
Yeah.
and you're the only title, you can't say it's just me. You have to be honest, the honesty policy, and say, yes, I'm married, my wife's not working, and then they'll class you as having a dependent regardless of who's on the title.
Yeah.
Can you have a fight and break up for one day and then,
So
Just don't tell you broke up.
and then just reconcile?
yeah. So the point I raised there is if you've got joint savings. So you and your partner have saved, say, a deposit to purchase a property, and then you want to go and buy a property, but just in one person's name. Because that money is jointly held, the bank's going to want to see proof of it.
Yeah.
And obviously, if it's a joint bank account with another individual, they're not going to essentially lend on that deposit.
Yeah.
Yeah, they want to see that deposit in an
Because you
individual
both
name.
jointly saved for the deposit, then they're going to say, well, you both contributed to the deposit, which means you're both going to be assessed on the loan.
Yeah.
Mate, I think it's been a good chat. Is there anything that you would like to, that you don't think we've covered, that you think, or you'd like to double down on, before we sign off on our chat?
Do you guys have any questions? Anything? Anthony looks like he's got a question.
No, that's pretty much covered everything. That's very good.
I think if there's any point, like any closing point, it'd be for clients or potential property investors, is especially for younger ones, is to start as soon as you can.
Yeah.
And that sort of goes without saying. And probably one of the most important points in my experience is to is the power of compounding. Now, a year five student could explain compounding, right?
Yeah.
Compound interest. Like everyone in theory knows what compound
Can you
interest
imagine
is.
Alex's kids?
Yeah. I don't know.
Hopefully they're as fun as you, mate.
they'll be looking at amortization calculators. No, they won't.
All right, kids, I'm going to fun Saturday game. Bring out the calculator.
So like it would be like the power of compounding, and in theory that is just so everyone knows what compounding is, but to actually, when you're seeing the value of your assets, and from my perspective, seeing the value of my clients' assets and your clients' assets go up in value, it's a very empowering concept to see these particular people, see their wealth literally increase year on year. And compound and grow. It's a very powerful thing. Yeah. Not only to see in theory, obviously, but also to experience. And if there's anything I could pledge today, to be, start now, start sooner rather than later.
The best time to invest is yesterday.
You're quite right. Yeah.
Mate, I think you're bucking the trend of the misconception about financial advisors brokers. You're much more fun than what they lead on to believe.
Well, I believe the average age is 49. So I'm a bit
what?
younger than that. 49 years of age is the average financial advisor. So
What are you, 48?
yeah, literally going on 49. So I hope I can bring a little bit of fun to the table.
Mate,
But,
you've brought it. We'll be back on next with some chats about SMSF.
Sweet.
And what that means for the listeners.
Looking forward to it. That's a very fun topic.
That's a good one.
Yeah,
Thanks,
yeah.
mate. Thank
Cheers.
you.